All right. All right. Welcome, everyone. Thank you for taking the time today. My name is Lee Boone, founder of Buckeye Financial LLC. Whether you're a business owner, a CPA, or an estate attorney in this room, what I'm going to walk through applies to your world. How successful families and business owners are funding large life insurance policies without writing a check out of pocket, and why that matters for clients you are and that you already serve. Quick introduction before we go further. My name is Lee Boone. I'm the founder of Buckeye Financial LLC, and I spent over 20 years in this industry, built a practice serving 3,000 clients plus, and I bring the same discipline from my playing days at The Ohio State. We were national champions in 2002, and I was a free safety, which is where defense wins championships comes from as a philosophy for how I approach protecting what my clients have built. I'm licensed across 8 states, and for advanced strategies like premium financing, I don't do this alone. My case design team brings over 100 years of combined experience across cases like these and others, and I work hand in hand with each client's CPA and estate attorney, not around them. Here's the core problem we see over and over with successful business owners. Their wealth is real, but it's tied up in the business, in real estate, in things that take time to sell. Estate taxes and buy-sell obligations don't wait. They're due in cash, often within 9 months of a death. Without a plan, families end up selling assets fast, sometimes at a steep discount, just to cover a bill. That forced sale scenario is exactly what life insurance is designed to prevent. In simple terms, instead of the client writing a large check every year for premiums, a bank pays them. The policy is owned by an irrevocable life insurance trust, so the death benefit stays outside the taxable estate. The policy's cash value, along with other pledged collateral, secures the loan. The client's only real out-of-pocket cost is the loan interest, which is often lower than what their capital is earning elsewhere. And at death, or whenever the client chooses, the loan is repaid from cash value, outside funds, or the death benefit. So why does a family that could technically write the check choose to finance instead? 4 reasons. 1. Their capital keeps compounding where it already is instead of getting tied up in premiums. 2. Financing makes it realistic to buy the full amount of coverage a large estate actually needs, not a scaled down version. 3. Held correctly in an irrevocable trust, the death benefit is designed to stay outside the taxable estate. And 4, for business owners specifically, this preserves working capital that would otherwise go to funding a buy-sell agreement or key person policy. This strategy is not for everyone, and frankly, part of my job and yours as a CPA or an attorney reviewing this with a client is screening out the people it doesn't fit. The right client generally has a net worth north of $5 million, has real illiquid wealth tied up in a business or real estate, and has a genuine need for a large death benefit. It is not a fit for someone who couldn't handle a collateral call in a rough year or who just wants cheaper insurance. This is a leverage strategy, not a discount strategy. I want to be as direct about this as I possibly can, especially with the CPAs and attorneys in this room, because your clients are trusting your judgment on this. Premium financing is leverage. It carries interest rate risk. Since most loans float with SOFR, it carries collateral call risk if the policy underperforms. And it carries exit risk if the client needs to unwind early. None of that means this strategy is bad. It means it has to be underwritten conservatively, illustrated honestly, and reviewed regularly. This is exactly the role our case design team plays, and exactly why we want your eyes on the case too. Let's make this concrete with a hypothetical. Say we have a business owner worth $18 million, mostly tied up in the business and real estate, who needs a $10 million death benefit for estate and succession planning. Premiums on that size policy might run $400,000 a year. Paid out of pocket, that's $400,000 a year, not compounding in the business. Financed, the client's real cost is loan interest, and the $400,000 keeps working where it already is. This is illustrative only. Every case is designed around the client's actual age, health, and numbers. For the CPAs here, this isn't a strategy that lives in silo. It touches the client's tax picture directly. How the ILIT is structured, how loan interest is treated versus a premium expense, and how it affects the client's overall cash flow and basis planning. Now, I'm not here to replace your role. I'm here to bring the insurance and lending mechanics so you can evaluate whether it fits the plan you're already building for your client. For the estate attorneys, the trust work here is exactly your lane. The ILIT has to be drafted and administered correctly. Crummy notices handled properly, and trust duties clearly defined. Beyond the drafting, this strategy is really about solving the liquidity problem your clients face in estate settlement and business succession. If you're already drafting buy-sell agreements for a business owner client, this is a natural extension of that conversation. Here's how the process actually works when we take this on together. We start with a discovery. Call to confirm the client really fits the profile. From there, our case design team structures the arrangement with the carrier and the lender. Before anything is signed, the client's CPA and estate attorney review the tax and trust structure, that's you, then underwriting and policy issue, followed by an annual review of the loan, the collateral, and the policy's actual performance. This isn't a one and done transaction. If what you heard today and anything you heard today sounds like a client you're already working with, or sounds like your own situation, the next step is simple. Let's get 30 to 45 minutes on the calendar with our case design team and me. We'll look at real numbers, not hypotheticals, and I'll tell you plainly if it doesn't make sense for the case. For the CPA and the attorney in the room, I'd also love to talk about how we can work together on an ongoing basis for clients who fit this profile. Thank you.